It's Brian Preston, the Money Guy.
All right, Nick has a question out on YouTube. He says, when hiring a fee-only advisor with majority of assets in a 401k, IRA, and HSA, where can and should the fees come from? Can I make a distribution for management fees, or do I need to use money from other savings?
That's a good question.
Yeah, so what Nick is asking is, so a lot of times when you work with a fee-only financial advisor, and we fall in this camp, the way that we work is we get paid a percentage based on the assets that we're helping you manage. So even though the services may be robust and there may be a lot of different areas that the advisor helps you with, the fee is pretty simple and pretty easy to calculate. You just take the value of the assets multiplied by the specific percentage. But he makes a great point. A lot of times when you're working with an advisor, if they're looking at your 401k or looking at your 457 or looking at your 403b, and the advisor bills your investment accounts directly, they can't bill the 401k directly, or they can't bill the 403b directly. Well, I say that. If you have a Schwab 401k, Charles Schwab 401k that has a PCRA account, or you have a 403b that is with Fidelity, they do allow direct advisor billing, which is an incredible benefit. If that's not something you've looked at, you ought to look at it. But in most cases, you can't bill those accounts directly. So he's saying, I want them to give me advice. I want them to be able to provide me some counsel on that. What's the best way for me to pay for that? Well, the first thing I don't think it would make sense for you to make distributions from your 401k or from your retirement account in order to pay the advisor fee. Because if you're doing it in such a way where you take distributions, number one, your plan has to allow for what are called in-service distributions. A lot of plans won't do that. If you're still working and still an active participant, you can't pull money out anyways. The second thing is, if you pull money out of those retirement accounts and you're pre-59 and a half, you're going to pay, or pre-55 for sure, you're going to pay income taxes as well as likely a penalty on those distributions. So it doesn't make sense to actually pull money from the retirement accounts themselves unless you work with one of those unique providers like Schwab or like Fidelity where they can do direct advisor billing. So given all of that context, if it doesn't make sense to take a distribution, Brian, how do clients pay for the 401k assets or the 403b assets?
Yeah, I mean, this is one of those things when people come, we have people reach out to us. I mean, one of the things when you do the questionnaire, you'll notice we ask you about account structure. It's so important because one of the most frustrating things, just I'm sure for you, because you fill out the paperwork, and then for us, is to tell you, hey, we'd love to work with you, but your account structure just doesn't allow for it to work. Because, I mean, if all your money is in a Roth 401k and there's no ability for us to pull the fee directly out, or even if there was, that's pretty valuable. It gives us a lot of pause because we're not trying to just get clients at all purpose. We want it to actually be a win-win situation for you as well as for us. I wrote down 3 quick notes. I love billing out of tax-deferred accounts because realizing when we talk about the 3-bucket strategy, we have after-tax, which is your savings and your brokerage accounts that you can pull in and out of pretty easily. We have your tax-free, which are all your Roth accounts. And then we have your tax-deferred. Tax-deferred accounts get filled up when you make lots of money and you're trying to make your contributions pre-tax to avoid the current taxation because you think in retirement you'll be taxed at a lower rate. But also they get filled up like the stray puppy that follows you home because your employer has to put the money in from into those tax deferred so they can take the deduction for the funding. So those accounts just automatically grow. What I love about taking fees out of tax deferred accounts is we know when you do retire, you're going to have to pay ordinary income taxes on that. It's going to come out at the higher rate. The government loves this so much, they even have what's called required minimum distributions once you reach age 72 to force you to take these money out of these retirement accounts. So if I can pay fees out of tax deferred money, it's huge because think about it, this is money you took a tax deduction on, whether you took the tax deduction or your employer did to get in this account. So it's never been tax money. If you can pay an advisor off of that account, in your own little way, you're kind of
Uncle's paying for some of it.
Helping whatever your marginal tax rate is. That's what Uncle is paying on your fee.
It's huge.
It's kind of cool because you're like, man, the uncle. I feel like I pay all these taxes. What do I get from my favorite taxing uncle? Well, in this case, they're going to pay for probably a third of your financial planning services, which is pretty powerful. So I love, and that's why when you do have an employer like a Fidelity or a Charles Schwab that will let you through some of those special arrangements Bo mentioned, pay your fee directly to your advisor, that's a super beneficial thing because it allows you to get the planning you need, but also pay it in a very tax favored way. Roth, I wanted to just put a comment out there about Roth IRAs. We try at all costs not to bill on Roth IRAs. Look, the government restricts
the dollar's just too valuable.
How much you can put in this account. When the government's restricting how much you can put in, you have to pause and be like, man, if they're not letting me put in but this much, I want to be careful that I'm not gutting that long-term benefit by taking fees out of this. So we try to avoid billing on Roth accounts as much as possible. And then after tax accounts, we don't mind because sometimes you'll get squeezed in a situation where a client does have tax deferred or Roth product, accounts, and you don't want to bill out of those. So where the government lets you take that money without getting into any issue is in the after tax, that brokerage account. We have no problem with that, but you are paying with after tax dollars. The only thing I don't like is if your account and your taxable is so small that we actually are taking away from your liquidity. That bothers me.
Not ideal.
It's not an ideal structure. So, Nick, your question is an outstanding one. And the fact that you do need to look at, and this is why we talk about the 3-bucket strategy as well, is because just like it gives you, the 3-bucket strategy gives you the flexibility at retirement to manipulate legally how much in taxes you pay, it also, the 3-bucket strategy, and that's why we talk about it in step 7 of the financial order of operations. If you go to moneyguy.com/resources, you can download this or the deep dives at learn.moneyguy.com. We talk about the 3-bucket strategy because it also allows you to have options on how you access your capital or pay fees if you have an advisor. There's all kind of cool, really deep dive benefits to having options by having your account structured in a way that's very tax efficient, but also very liquid efficient. And that's something that I think Nick is obviously scratching up against this. And I kind of laid out how all the 3 different buckets are handled so you can look at your own assets and figure out if this is a good fit for you.
Love it.